Nvidia has spent the AI boom selling the chips everyone wants. Now it is being asked to help finance the customers buying them, and that is where the story becomes much more dangerous. Nvidia and OpenAI are reportedly close to an agreement for a giant artificial intelligence data center in Ohio, but Nvidia has dramatically reduced the amount of financial risk it is initially willing to take. The chip maker had discussed guaranteeing roughly $250 billion connected to the project. The revised plan would put Nvidia's initial guarantee below $120 billion and limit that support mainly to the first phase. The change came after investors raised concerns about how deeply Nvidia was becoming financially tied to the companies buying its own hardware. That may sound like an obscure financing adjustment, but it reveals one of the biggest changes happening inside the AI industry. The first stage of the boom was funded largely by giant technology companies using their own cash. Microsoft, Amazon, Alphabet, and Meta could spend tens of billions of dollars on GPUs and data centers because their existing businesses generated enormous profits. The next stage is much larger. OpenAI, Anthropic, CoreWeave, and other AI companies want infrastructure measured in gigawatts, but many of them do not have the balance sheets of established cloud giants. Artificial intelligence is therefore running into an old-fashioned bottleneck: credit. The Ohio project shows how extreme the numbers have become. The proposed campus is expected to reach roughly 10 gigawatts of power at full scale, making it one of the largest AI infrastructure projects ever attempted. The broader project could cost more than $500 billion when the data centers and computing hardware are included. Nvidia's earlier $250 billion guarantee was intended to help support leases and construction financing, while separate discussions reportedly considered as much as $350 billion more in financing for OpenAI's chip purchases. The first phase is now expected to receive the strongest Nvidia backing, with later phases reconsidered after the project proves itself. This structure exists because lenders are being asked to finance assets on a scale that barely existed a few years ago. Imagine a bank financing a new factory. The bank can study historical demand for the product, the resale value of the equipment, and the company's credit history. AI infrastructure is harder. A lender may be financing billions of dollars of processors that could become technologically outdated in only a few years, inside a market where customers, models, and pricing are changing extremely quickly. If OpenAI signs a long-term lease, that helps. If Nvidia guarantees part of the financing, that helps even more, because Nvidia has one of the strongest balance sheets in technology. The risk that originally belonged to OpenAI and the data center developer begins moving toward Nvidia. That is where the circular nature of the AI boom becomes uncomfortable. Nvidia sells the processors. AI companies need those processors to grow. If those customers cannot independently finance enough hardware, Nvidia can help guarantee the infrastructure or connect them with lenders. The financing allows customers to buy more Nvidia equipment, which increases Nvidia's sales and reinforces demand for more data centers. Nothing about this is automatically fraudulent or economically irrational. Vendor financing has existed in industries from aircraft to telecommunications for decades. The problem appears when the supplier becomes increasingly responsible for financing the demand for its own products. Investors notice that risk immediately. Nvidia's shares fell sharply after the original $250 billion guarantee discussions became public in July. Reuters' Breaking Views noted that Nvidia generated roughly $100 billion in operating cash flow in fiscal 2026, meaning it had the financial strength to support customers, but the company itself has warned that future financing arrangements could reduce upfront cash flow and increase credit exposure. Selling picks and shovels to a gold rush is an extraordinary business. Guaranteeing the miners' debt so they can continue buying your shovels is a very different one. The reduced guarantee does not mean Nvidia suddenly believes the AI boom is collapsing. In fact, the company is simultaneously creating an even larger system for financing AI infrastructure. Nvidia recently partnered with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to build financing platforms intended to raise more than $500 billion in third-party capital. Jensen Huang said Nvidia could backstop up to $125 billion, or roughly a quarter of potential deals. The objective is to move more of the financing burden away from Nvidia itself and toward insurers, asset managers, banks, and private credit investors. This may be one of the most important developments in the AI boom because it turns computing infrastructure into a new financial asset class. Instead of a technology company buying servers directly with cash, investors could finance AI facilities in structures closer to real estate, infrastructure debt, or equipment leasing. The servers become collateral. Long-term computing contracts generate the cash flow. Banks and private credit firms provide debt. Nvidia may guarantee part of the residual value of the hardware. If this market develops successfully, trillions of dollars of outside capital could enter AI infrastructure without requiring Microsoft, Amazon, or Nvidia to put every dollar on their own balance sheets. Goldman Sachs analysts estimate that the four largest hyperscalers alone could spend more than $5 trillion on technology and data centers by 2030. Big tech companies are expected to spend more than $700 billion on AI-related infrastructure this year. Financing that level of construction entirely with corporate cash becomes increasingly difficult even for the richest companies in the world. Private capital, therefore, starts to matter almost as much as processors. But finance does not remove the underlying economic risk. It redistributes it. Someone still needs to repay the debt. Someone still needs the data center to generate enough revenue. Someone still needs the Nvidia GPUs to remain valuable after newer processors arrive. The central assumption behind these deals is that future demand for AI computing will be enormous and persistent. If that assumption is correct, the financing structures could look brilliant. Lenders receive long-term returns, AI companies gain access to scarce computing power, Nvidia sells more hardware, and data centers become productive infrastructure supporting an entirely new economy. The danger is that AI efficiency is improving at the same time infrastructure commitments are becoming enormous. A model released 3 years from now may require much less computation for the same level of performance. Sparse architectures, better inference software, custom chips, and smaller specialized models are already reducing the cost of useful AI. DeepSeek and other lower-cost model developers have shown that companies do not always need the most expensive frontier hardware for every task. If a future model can perform the same work using a fraction of today's power, data centers designed around current assumptions could be less valuable than lenders expect. There is another uncertainty: AI revenue. OpenAI has hundreds of millions of users and rapidly growing enterprise products, but building hundreds of billions of dollars of infrastructure requires more than popular software. Those facilities must eventually generate enough cash to cover electricity, hardware depreciation, maintenance, financing costs, and the continuous replacement of processors. AI agents may create that demand because one autonomous task can generate dozens or hundreds of model calls. Coding agents, research agents, and enterprise automation could consume far more computing than ordinary chatbot conversations. But nobody yet knows exactly how large that market will become or how quickly falling inference prices will reduce revenue per unit of computing. This is why the revised Ohio deal is so revealing. Nvidia is still willing to support the project, but it wants to stage its commitment. The first roughly 5 gigawatts would receive Nvidia's initial financial backstop, while the company could decide later whether to support the remainder. OpenAI is still expected to commit to the full capacity through a binding lease. In practical terms, Nvidia is saying, build the first enormous machine, prove that the economics work, and then decide how much more risk to take. The strategy also protects Nvidia from a conflict at the center of its business. The company benefits when the industry believes computing demand will keep rising. Its valuation, customer spending, and future chip sales all depend partly on that assumption. But if Nvidia guarantees too much financing, investors may begin questioning whether reported demand reflects genuine independent purchasing power or demand supported by Nvidia's own balance sheet. By bringing Wall Street institutions into the financing structure, Nvidia can continue expanding the market while making the ecosystem look less dependent on one supplier funding its own customers. The wider AI industry is moving in the same direction. Meta has used outside investors to finance large data center projects. Anthropic has infrastructure arrangements supported by major technology partners. Broadcom has participated in financing structures connected to custom AI hardware. Private credit firms increasingly treat data centers, power agreements, and computing equipment as investable infrastructure. Artificial intelligence is becoming less like traditional software and more like telecommunications or energy, where enormous upfront investment is financed over decades. That transformation changes what it means to compete in AI. A few years ago, the central questions were model size, benchmark scores, and access to GPUs. Today, the winners also need land, electricity, transformers, cooling systems, memory, networking, and hundreds of billions of dollars of financing. The smartest model in the world is commercially useless if the company cannot afford enough infrastructure to serve customers. OpenAI understands this. Nvidia understands it. Wall Street is beginning to understand it too. The risk is that financial engineering can make expansion easier without making the underlying technology more profitable. Cheap credit can accelerate a boom. It can also amplify a mistake. If AI demand continues growing faster than supply, the current build-out may eventually appear conservative. If the economics weaken, the industry could discover that it built extraordinarily expensive infrastructure around assumptions that changed faster than the debt could be repaid. Nvidia reducing its initial guarantee from $250 billion to under $120 billion is therefore not a retreat from artificial intelligence. It is a sign that the AI boom is entering a more mature and complicated stage. The easy money is disappearing. Computing demand is still enormous, but somebody must decide who takes the financial risk behind that demand. For years, Nvidia's greatest advantage was that everyone needed its chips. The next question is whether Nvidia can keep selling those chips without becoming the bank that finances the entire industry buying them.